The story here is the driver of gold. Now here we see a sell-off in New York when New York isn't even buying gold. The U.S. Fed, they don't buy gold. But guess who is buying gold? All the other central banks. But yet the sell-offs in New York, who isn't even buying gold. And the biggest driver of gold is the central banks. And so central banks are buying gold and New York's selling gold. I mean, it's somewhat hilarious. Okay, so these are the stocks that I created a list of stocks that I thought should have a full allocation. So any stocks on this list that I don't have a full allocation on, I have on my buy the dip list. So I have.
You're watching CapitalCosm. My name is Danny. My guest today is none other than Don Durrett, and he couldn't be more apropos. October 21st, 2025, and the precious metals complex is bleeding out profusely here, Don. I'm looking at the gold price right now, currently at $4,107 on the spot market, down 5.7%. Silver also down, but up a whopping 8.3%, down to $48 in the spot market. What's your analysis here, Don? Is this the end of the bull market, a correction? What do you make out of this price movement?
Yeah, it's really interesting. So I mean, gold's down like $250, and I like have no emotion at all. It's like so what? Because I've been through a lot of corrections. You know, I've been basically a Bitcoin investor since 2016, and a gold investor since 2004, and juniors. I mean, I've been through a lot of corrections. So for me today, it's the people are, you know, oh my goodness, you know, my portfolio is down 10% in one day, and for me, it's like, which direction are we going in? Are we going down? Or are we going up? And I have no doubt that the trend is up, not down. I mean, look at all those green candles. I mean, we've been going up and away. I mean, this when we broke through $2,000, I mean, we never looked back. We didn't retest 2,000. We didn't retest 3,000. We still haven't retested 4,000, but we might. Maybe we will. Maybe we won't. But this trend is up, and so until you get lower lows, you know, we're really early. You know, we're in a bull market until you get, you know, like last week, for instance, the HUI was actually a green candle last week, and so yeah, we had a big sell off on Friday, but we had a major run up from Monday through Thursday. So we didn't even have a correction last week. Now this week, yeah, we're going to get a red candle. This will be the first red candle in the HUI. So go ahead and bring up the HUI because that's the miners index, and that's kind of that's what I do. I do miners. Can you do the weekly on the HUI? I think the weekly is much more important. So this is the weekly on the HUI. So you go back to the beginning of 25, you can see it's just been all green. You know, just green candle after green candle. We had a couple of red candles, but basically, you know, every
up
week
137% year to date.
Yeah. And so we're going to get a red candle this week, but are we going to get 3 red candles in a row? I don't think so. Is this trend again? Yeah, I mean, you can have, like, we got stuck. You can see where we kind of got stuck there. We got stuck at $3,300 gold, and you can see it from like April to August. We didn't do much. If you go to end of April, 330, end of April to August, in the beginning of August, that was a pretty long little consolidation where we didn't do much. Yeah, right there. We didn't do much for a long period. So maybe we get into another one of those. But as far as I'm concerned, it's just, you know, a correction that was kind of necessary. It was a little more harsh than I was expecting. But that 10% that we had today, that could have happened over 3 days, right? It just happened to happen in one. Well, we're down like 15% since Friday from the very top. So from the very top, you know, we're probably down around 15% from the very top. What we got to about 1680, somewhere 1690. So 10%, 70. So we're only down 10% from the top there. So, maybe I've been saying you're in a bull market, you're going to see a 20 to 30% correction. It's going to happen. And so is this the 20 to 30% correction? I actually don't think it is. And the reason why, so in other words, this is one correction that we're going to have. This is the bull basically shaking off kind of the tourists, the posers, the people that, aren't really serious about being an investor. And so the bull's going to buck. But I think the deep correction, the 20 to 30% correction will occur when the S&P crashes. So for me, this is probably a buying opportunity for people that are buying. I wasn't planning to buy in October. I mean, October's almost over now. I mean, if this corrects a little bit, the HUI corrects a little bit more here, I might buy a few stocks over the next couple of weeks if this thing goes a little bit lower. But I'm waiting for the S&P 500 to crash, and I think the bigger story here isn't gold, isn't silver, it's what's driving gold and silver. That's the bigger story, and that's what's pushed gold from 2,000 to 4,000, and what's going to push gold from 4,000 to 8,000. Is the drivers of gold. That's the most important story here. Those drivers that are pushing gold higher, that didn't change today. As a matter of fact, there was no news. Right. There was no news that pushed gold down today. None, right?
And you'll notice that the sell-off began during overnight trading. I noticed that it began sometime around 4 or 5 a.m. Eastern, Yeah,
absolutely. The Eastern markets didn't cause this. The majority of the sell-off happened after that 5 a.m. The open on was down like 130. Gold was down like $130 on the open, and it ended up down $250. So most of the selling was in New York, and the buyers of gold is not New York. The buyers of gold is in the East, and so you're getting a sell-off in the West. It's like the West says, we don't need no stinking gold. And the East goes, well, we'll take it. You don't want it. So that big sell-off today was not like in the East. It's like the banksters. That was like a bankster sell-off. It's not the real McCoy.
So on the hourly charts, you see this red candlestick. This is really what started it. This is at 7 o'clock Eastern time.
Exactly.
And you can see it dumping. Now it's kind of, you see these long wicks here, kind of finding a bottom here. At around 4,000.
Let's see where we are over the next 2 weeks and over the next 2 months. Again, the story here is the driver of gold. Now here we see a sell-off in New York when New York isn't even buying gold. The U.S. Fed, they don't buy gold. But guess who is buying gold? All the other central banks. But yet the sell-offs in New York, who isn't even buying gold. And the biggest driver of gold is the central banks. And so central banks are buying gold and New York's selling gold. I mean, it's somewhat hilarious. And the reason why that you can see these kind of sell-offs is that New York has all the money. New York's the financial powerhouse of the world. We have 23% of GDP, but the market, the New York has got like 60% of all the stock market money. And so all that foreign money, 20% of our stock market is foreign money, and it's hot money. So it's about $12 trillion. So that $12 trillion is hot money. And so New York's got all this cash, all this liquidity. And they're like, they're like the gorilla in the room, and they have to push people around. Today they push gold around, and silver went down with it. And that's what silver does. Silver just follows gold. But the story here again is what is driving gold? What are the drivers of gold? Why did gold go to 2,000 to 4,000? I think that's the bigger story. 26, 27 is going to be a bloodbath, I believe, in the U.S. stock market and the U.S. economy. I'm calling it the Humpty Dumpty crash, because when this stock market crashes, they're not going to be able to put it back together again.
Interesting. So you said that this price move may provide an opportunity to buy in some more. But if we are to anticipate a wider market crash that could bring down the precious metals, upwards to 20%, wouldn't it be more prudent just to wait for that crash to happen? Or what's kind of the rationale there?
Well, I believe that you don't trade a bull market unless you're a trader. So if you're an amateur, you ride a bull market. Now it's okay to trade kind of a bear market, like from 2011 till now, because we were in a bear market, and during that period you could kind of trade it. You could basically sell tops and buy bottoms because it was going to keep going up and down, up and down. But in a bull market, you kind of want to ride it. For instance, you wanted to buy the S&P at 666 in 2008 when it hit the bottom. You want to buy it, buy the QQQs and just ride it and just ride. You didn't want to trade it. You don't want to be smart. If you did that, you had a 9-bagger. You just get on that train and you ride it until it ends. And that has been the smart thing to do. And in a bull market, if you get higher highs, then it's better just to ride it than try to outsmart it and try to trade it. Now, a lot of people traded this, they got off because it went straight up, and there's a lot of people that took profits, had cash on the sidelines, but now they're in a situation where they have to figure out when to get back in, and I'm probably most of them didn't get in today. They're like, no, this is a crash. We're going to go lower here, right? They get a red candle like that. So let's say that people got off, below the red candle. And now they're like, okay, I'm going to wait until it gets lower. But how much lower is gold going to go? Is it going to go, say, to 3,700? It might not. And then if it doesn't go down there, you're waiting. And then all of a sudden it rips back to 4,200. It's difficult to trade. It's difficult to know when to get in, when to get out. It's not easy. So I say leave that for the professionals, especially in a bull market, because in a bull market, I mean, we saw gold last week go up $350 in 1 week. And we saw silver go down today $4 in 1 day. It could easily go up $4 in 1 day. And so I think riding bull markets is the way to go. The key here is are we in a bull market? And I think we are. So you have to believe you're in a bull market. If you're in a bull market, you're going to have higher highs, not lower lows. And the other thing you have to, for me, as far as in a bull market, I think the free cash flow multiples is a real indicator that we're early in a bull market. In other words, not late stage. For instance, the stock market, the PE is at 23. That's very high. So that's basically showing an overvalued market. Whereas in the mining space, I don't use PEs, but they're still really low. If you look at the free cash flow multiple, it's below 10. Right now, like Newmont's trading like a 6 EBITDA, and you can add like 30% for that free cash flow. It's about a 9 free cash flow multiple. Those are like 50% of what they should be in a good market, and they're not even overvalued. I mean, to get overvalued, we need to get Newmont like above 18. So from like a free cash flow multiple. So a free cash flow multiple is somewhere like 13. You got to get into teens. 13 to 18 is like kind of normal if they have high free cash flow. We're not even close to that. We're 9. And so the multiples in the miners, I'm using Newmont because it's kind of a bellwether, but until those free cash flow multiples go up a little bit, we're early. And so we're early in a bull market. Even though gold is ripped from 2,000 to 4,000, I still think we're early there. I think silver just got to an all-time high at 50. I think it's going to 100 to 150. So we're early. And today's correction, you can buy the dip. Now, I personally want to wait because the stocks that I'm going to buy are high quality producers that I already own. I think I'm going to get them cheaper, and I own them. I already have good positions. Now, any stock that I'm underweight, I've already kind of bought. So if I'm underweight a stock, I'll add to it. But I'm not really underweight stocks, but I like to buy dips. So there are a few stocks that I could add allocation to, but I don't think now's the time. I'm going to wait for the S&P to crash, and I'm expecting it to crash. Not only am I expecting the S&P to crash, but I'm expecting what I call a Humpty Dumpty trade. This is going to be a crash where they can't fix it. That's my expectation. I don't think they're going to be able to fix it. This is when it all breaks down. This next crash is coming, and that's when the fear trade finally arrives. I've been waiting for this the very final thing to happen. So we got a bull market in gold. I basically said that in February of 24, March, April of last year, that basically we don't have to worry about gold anymore. Now today we had a $250 drop, but if you look at the candles, it was kind of like off to the races kind of thing. The bull market started in December of 19, in my belief. Now some people say it was 2016 because that was the low, but from 2016 to December of 2019, the gold market did nothing. It broke out. If you look at the chart, bring it up, Danny. December of 19 was when gold basically had a green candle and kind of we never looked back. It was December of 19. So that's kind of when, you need to go to December.
Monthly candlestick?
Yeah, you can do monthly, yeah. So we go to December of 19.
Let's see.
There we go. That's good. Now go find a candle. Okay, back up. Okay, no, there we go. Okay, so there we go.
There it is.
November. Right. All right. So we're kind of flat there. Can we see a little bit more years? You do the monthly, but I want to see more years.
Gotcha. Yeah,
There we go.
right.
Okay.
There you go.
Okay. So, all I need to see is like back it up to 2009. So give us a little bit of room. There we go. That's good. That's good. Okay. So now what we're looking for here is because the bull market is going to last about 9 years, I think. Okay. So you can see we went into that cup 2013, 2015, 2017. So you see, look at the bottom of that cup, right? 2015. Look at that. So we're in the bottom of that cup. I don't think right there. We had a little bounce, but that wasn't a breakout because then look, keep going forward. And you see we went down again. We go down again right there. And we're still there right now. Now we're in 2018 right now. Keep going. We're just about there. One more. Stop. Go back a little bit. Go back a little bit more. Go back right there. Okay. So it was May of 18. So see those candles right there.
Yep.
So so this is when we were breaking out in 2019. I don't see 2016. The bottom was 2016. You can see the bottom, but I don't think that was when the bull market started because we flatlined for like 2 years after 2016. I think it was 2019. Okay, so we're there. Then if you go to March of 24, so then we were flat, and then we flatlined from 2020 to 23, 24. Now you go,
and it's the same pattern too. It's the same pattern. You've got like what 5 or 6 red candlesticks consecutively, and then it breaks out.
Right. So go to March. Go to March of 24. So that's October 22. Go to March of 24. December. Oh, actually, it was 20. Keep going back. Go back. March 20. Oh, there was March 24. Yeah, that was the big candle. Go to March of 24. That big green candle. Yeah, that candle stopped right there. That candle right there. Look at the bottom of that candle where it's at. It's at $2,000. See that? That's where we broke out. That was the breakout right there. That was the breakout. That's when the gold basically said, I'm out of here. I'm off to the races. And that's when I basically said, we don't have to worry about gold. That was the beginning of where we're heading. I think we're heading to at least 7,000-8,000. Okay.
All right, quick break here because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Just click on the link down below in the description box and use promo code COSM10. Now let's get back to the video.
Then that happened for silver. Now we bring up the silver chart. So gold broke out right there in March of 24. Now bring the silver chart in and go to August.
August of 24?
No, August 25.
25.
Yeah.
Okay.
Right there. Okay, so that candle right there, when we got through August, you go to the beginning of August, back it off all the way to the beginning of August. Stop right here. Go to the candle and look what the price was at the beginning of August. $35, right? $36. Mm-hmm. So that was the candle that went from 36 to 39. But that was when people started buying the miners, when the miners were outperforming the metal. And so that candle is the equivalent of March of 24. And that's when, so you had gold basically saying, okay, I'm out of here. And this is silver saying, okay, I'm out of here. Where this is the beginning of a run. And that's when, and then the third thing that happened when that did that. So the next chart to bring up is to bring up the HUI. So we basically need four things to happen. So the next thing was the HUI. Now, okay, so we want to go to August of 24. And you see once silver, that's October, we want to go to August. Keep going forward.
August of 24?
Oh, okay, 25, excuse me, 25. Right there, that candle. Okay, so that candle started at 400, but notice the candles below it. So just leave it right there. Notice the candles below it. You could say that it broke out like 5 months before. You could say that at 300 when it got above 360, and that was kind of the channel. 360 was the channel, but those candles after we got above 360, they were very small. This is monthly candles. Those candles were very small in July, June, May. But that candle in August was okay, boys. And that's when silver joined the party, right? Okay, so the bull market in the miners started in August. That it just started. We're just beginning. This was when all the money started coming in. This is when my website just exploded in August. And so we need one more thing. Now the last candle, the last one hasn't happened yet. Now this is going to be fun. Now bring up the S&P. Now wait a minute. You got the HUI here. Okay, all right. Okay, so leave it the HUI there. Okay, you got the monthly. Overlay the HUI.
Okay.
Now this is what we're waiting for. This is the final shoe to drop. It hasn't happened yet. So overlay these on a monthly. And now back this off all the way to 2000. Okay, stop right there. Okay, so now the bottom one. Okay, so we got gold. Okay, the SPX. It's the top, and then we got gold at the bottom.
The SPX is at the top. HUI is at the bottom.
HUI. Yeah, we can use this. I also like to use the gold price. But we can use this one. Maybe I should use the gold.
You want to look at gold? I can look at gold.
No, this is okay. This is all right. I want to show you this. Okay, now look at from 2000 to 2007. You see that we just goes up, up, up. So we start out. If you look at the bottom one, the blue line at the bottom, the HUI. Look at 2001 where we started. Look at the very bottom. Go down. Where we started. Keep going. Right
Yep.
there.
34.
Like 34, right? 34. That we went from 34 to 600.
From 2000 to 2011.
Yeah, 600. Okay,
I mean,
so
that's-
now look what the HUI did. Look what the HUI did from 2000 to 2007. It didn't do nothing. It went down, but it basically, I mean, if you look at the levels in 2004, so 2002, 2003, 2004, look at the HUI. It's basically not doing squat. And so that's what we need to happen. We need the HUI to basically go down to go flat. So basically so the HUI went down and you had rotation into the minors. So that was the 2001, that was the 9/11. So 9/11, you basically had a rotation out of the stock market and into the minors. And that's what we're waiting for. That's the final shoe to drop. Well, guess where the S&P is today? It's like at an all-time high. Very, very close to an all-time high. And gold's there. So we are waiting the last shoe to drop. We are waiting for the S&P to crash and to stop going up. And then you'll get rotation out of the $63 trillion stock market into the minors. That's what I'm waiting for.
I see. So let's go ahead and take a look at the HUI. I want to look at a ratio chart here. So let's pull up the SPX, the S&P divided by the HUI. We can kind of see some of this relative underperformance throughout the year. So S&P relative to the HUI, it's just now breaking down. Let's go look at the HUI relative to the S&P rather.
Right.
And there you go. HUI is all the way
Stop
down.
right there. This is beautiful. Look at 2001 to 2011. Look at that. Especially 2001 to 2009, but all the way to top.
Yeah.
I mean, just total outperformance. So that now it's starting again. So we went down, and look where we're at. We're just about ready to break out.
Yeah, and this is a log scale, mind you. So if I look at it from a nominal scale, it's even more profound.
Yeah, look at that. We're just now. That's what I said. This thing just began. The bull market in the miners just started. And this chart right here, this chart shows you exactly what I'm talking about. That we are early. So 0.1. And we're going to go all the way to 0.5, which is basically 3x higher here. So the HUI is going to go from 600 to 1800. And that's exactly my target. It's going to go from 600 to 1800.
But that's holding the S&P constant. If the S&P comes down, the denominator inflates and the ratio comes down with it.
Yeah, well,
the ratio goes up with it.
This ratio will go up, but the HUI itself will go from, it's currently at 600, it'll go to 1800. So as the ratio goes up, the HUI will go up.
Got it.
And this is what we're waiting for. So I'm sitting here, I'm like, so I'm actually just all bulled up. I'm like, we've been waiting for this breakout in the miners versus the S&P. We've been waiting for 14 years. We've been waiting a long time. And now we're just about there.
Yeah, this is a 10-year breakout. So if you draw a trend line from 2016 all the way out until today, you'll notice that looks like we broke out of the trend line this past month.
Yes, exactly. August.
Mm-hmm.
That's when it started.
Now we might come back down and retest the line at some point, but the point is that we have broken out of it.
Yep. And that's what it all started in August, September. So this is just a little correction. It's not a big deal. We're going much, much higher. This is like I said, today is like, okay, we got a little correction, but no big deal.
Now, if I'm looking at this gold chart, let's go back to the daily candlestick. I mean, this is though a pretty big candlestick here, Don. I believe this is the single biggest correction in the gold price since 2013.
Yeah, but it's a fake out. Remember, most of that selling happened in New York, not in Shanghai. It's equivalent to the U.S. economy, which is also a fake out. I call it a Potemkin economy. It's not real. It's all based on the U.S. government borrowing $2 trillion to create enough liquidity to keep everybody's heads above water. It's a fake economy. And that's a fake candle.
I see. So you mentioned that you have some gold and silver stocks on your watch list in the event that any buying opportunities come your way.
Right.
To the extent that you're comfortable sharing, like what are some of these stocks? If you don't mind me asking, if you do mind, then no worries.
No problem. But again, these are just stocks that I don't have a full allocation in.
Mm-hmm.
So it's kind of, these are stocks that are kind of my personal ones, but I do have a list of like 30 names that I thought are kind of would be good, really buy the dip stocks.
Yeah, you have a lot of lists, by the way. I follow you on X, by the way, Don. Yeah.
Yeah, yeah, because my database is very conducive.
Mm-hmm.
Very conducive. Can I share my screen?
Yeah, sure thing. Let me unshare. Go ahead.
And I'll show everybody these stocks that I think deserve full allocations.
Sure.
Okay, so these are the stocks that I created a list of stocks that I thought should have a full allocation. So any stocks on this list that I don't have a full allocation on, I have on my buy the dip list. So I have Avino, Jaguar, Endeavor Silver, 1911, Santa Cruz, America's Gold and Silver, Greatland Resources, Heliostar, Aris Mining, Discovery Silver, Gold Resources, Vizsla Silver, First Majestic Silver, Hecla Mining, Coeur Mining, Fresnillo, Hochschild Mining, Pan American Silver, Next Gold Mining, B2 Gold, West Gold Resources, Aya Gold and Silver, Cerrado Gold, Talisker Resources, Denarius Metals, Revival Gold, Skeena Gold, Regis Resources, Vault Minerals, Capricorn Metals, Silver Tiger, Free Gold Ventures, DPM Metals, which used to be Dundee, Artemis Gold, Perseus Metals, Endeavor Mining, and Equinox Gold. So those are, now I'm going to stop my share. Am I back?
Yep, you're good.
Okay, so those are all my, what I call full allocation stocks. Those are all the stocks that I want to have a full allocation. Now, full allocation is different from everybody. Some people, the full allocation is 5%. Some it's 3, some it's 2. It depends on your portfolio. And so determining, you have to determine, what is a full allocation. And so for me, I have a certain number. So I basically look at all those stocks and I make sure that I have, enough invested in them. And if I don't, I put them on my buy the dip list. Mm-hmm. So that's how I'm doing it. I'm adding shares to stocks I already own, quality names. So I have about, I don't know, I think about 8. That list, I only have about 8 of them that I don't have a full allocation.
Gotcha. Well, thank you for sharing that list here, Don. It's very helpful, and I recommend people follow you on X because you're always posting these interesting and cool lists of different gold and silver stocks across different domains. So thank you so much for your time, Don. Anything else you want to talk about that we didn't get into yet before we close things out?
Yeah, I don't think we did much justice to like my Humpty Dumpty trade. It's like, okay, Don, how are we going to crash? Doesn't look like we're going to crash. The stock GDP's at 3%. Unemployment rate's a little over 4. People are working. We got consumer spending. Everything's fine, right? Everything's fine. There's nothing to worry about here. And I think that if you look at all of the factors, if you factor in everything, you realize that the U.S. is in really deep trouble. And it all started, it kind of all started in 1972, 1971, but the Ukraine war. So this has been building So the U.S. has been living off of debt. So when Reagan came into office in 2000, our national debt was less than $1 trillion. And we didn't have high debt. We didn't have this, the annual budget in the 1970s, we never went over $100 billion a year. We had like $50 billion, budget deficits. We had little tiny ones. Reagan was the first guy to really have large budget deficits, annual deficits. So we started living on debt, and that's been building. And it really took off around 2000 when you had the dot-com bubble pop, and then you had 9/11 back to back. And then we had in 2000, we had about 5 trillion national debt, a little higher than that. Now we're at 38. So we've been adding debt at about 8% clip a year average, when GDP's been averaging about 4%. And now it's actually gotten more extreme. Now debt is even higher and GDP's lower. And then simultaneous to that is the dollar is losing its value, which is inflation. So there's two ways to look at inflation. One is the buying power of the dollar, and the other is the actual CPI number. Well, the actual buying power of the dollar has actually been going down at a much higher rate than inflation. If you do, what the buying power is, it's more like we're losing like 8% buying power. And so what's happened is in 2013, so we continuously have to rely on foreigners. We've been exporting debt. We've been exporting, so with reserve currencies, these other countries need our debt, and so we export our debt. Well, that's starting to end, where the foreigners, that's the reason why they're not loaning money out on the long end, like 10 and 20 and 30-year bonds. They're not doing that. Janet Yellen, she started borrowing everything on the short end, and Besant's doing the exact same thing. It's because we don't have any buyers on the long end. Nobody's interested, and it exposes us for having a weak bond market. But it's starting to break, if you will. And then in 2013, China had $1.5 trillion in our treasuries. They were the number one, 1.5 trillion. They've been a net seller every year since then. It's been going down. Now they're under 800 billion, approaching 750. So they've sold half of their bonds, and they continue to sell. And it's like, so in 2013, China just said, China figured it out. The U.S. is in deep trouble. We got to get rid of these bonds. There's a problem here. And now that is becoming more evident. And then the Ukraine war was kind of the trigger point that kind of pushed us over the edge, where there's no going back. There's no solution here. We lost control. So in many respects, we didn't really have a choice about the Ukraine war. Because we had to have an enemy. In Russia, we basically picked Russia. Russia was the very obvious, the obvious bad guy. You have to have an enemy in order to spend, money, large government money, on the defense sector, and kind of grease the wheels and keep everything running. But there's two things. So you get the benefit of a large defense budgets. And so when that war began, it basically, it gives the U.S. more influence over Europe because of NATO. So it was kind of a NATO war. But so we kind of pushed Russia into a corner. And then, Brzezinski talked about this in his book, The Grand Chessboard, is that the pivot point for Europe is Ukraine, because Ukraine is Russia's number one ally. And so if we want to make Russia the bad guy, then we basically, create a war in Ukraine. And so it keeps our influence. Now, what Brzezinski said is that he basically said that Eurasia is whoever controls Eurasia controls the world. And if we don't start that war in Ukraine, then Russia, which was creating this economic alliance with Europe, especially they're building a second pipeline into Germany. Germany and Russia, that pipeline was never turned on. Nord Stream 2 was never turned on. That pipeline gets turned on, then Russia and Germany become, simpatico. They become economic allies. And then Russia and China, they basically all become connected to Europe, Eastern Europe first and Western Europe. And then you have Eurasia. And then if there's no bad guys, if Russia isn't the bad guy, NATO goes away. And this is what Brzezinski said. Brzezinski said that the US cannot allow NATO to go away, because if it does, then it'll lose its influence. And then all of Asia and all of Eurasia, Asia will be controlled by China, and Eurasia will be China, that whole economic hub. And the US will be the odd guy on the out. And so we had a choice. We could either allow, according to Brzezinski, we could either allow Eurasia to unfold and let it happen, or else use Ukraine as a pivot point to buy ourselves time. So basically, and that's what we've been doing. We could buy ourselves time, and then and then try to keep Russia the bad guy, so that we keep our influence in Europe. And so that's what that war is all about. It's all about NATO and U.S. influence, and we got to keep our influence in Europe and in Asia both. And so now the Ukraine war, and Brzezinski also said that it's a lose-lose situation. We either allow Eurasia to unfold, or we create the war, and we eventually lose the war. He's like, Brzezinski said, there's no win here. It's a lose-lose situation, but if we do the war, we can at least buy ourselves some time, which is what we've done. But now it's becoming very obvious that Brzezinski was right, that even if we do the war, the U.S. is screwed. And we're seeing that through the BRICS. We're seeing that with the alliance of Russia and China. And we're seeing that with the alliance of Russia, China, and India. And now, now we're seeing it throughout all this whole BRICS alliance. We're seeing the entire southern hemisphere all aligning economically. And the U.S. is kind of the odd guy on the outside. And so this is all in motion. But simultaneous to that, it's very subtle, but China is rug pulling us very slowly rug pulling us, and watching the U.S. empire disintegrate on its own. It's very similar to Russia, where Russia said that the United States would destroy itself internally. Russia always said China is basically doing the exact same thing. They're just kind of sitting back and just watching the U.S. kind of disintegrate. And we've reached that breaking point. And so we're seeing our labor market since 2020 is slowly degrading, because the middle class has been hollowed out since the early 1970s. And so the middle class keeps getting more and more hollowed out. And so the middle class was always the strength of America. So America is like, we have this cancer, and we're just dying internally, slowly. And so now you look at our political system. So our political system is dysfunctional right now. I mean, right now the government's been closed for 2 weeks, so people haven't gotten paychecks for two weeks. And on Friday it'll be 3 paychecks they missed because of the dysfunction in Washington, which not going to get fixed. So the last shoe to drop is the economy. So if you're paying attention, you'll see that last shoe is going to drop. There's no preventing it. It's like this stuff has been in motion for almost 50 years now. It's been in motion, and now we're at the end game, and there's no stopping it. And it's just getting worse and worse and worse. If you're paying attention, you'll see it's just getting slowly. It's like the knot's getting tighter and tighter and tighter, and you're not going to prevent it.
Everything is degrading. There's a degradation of quality, like everywhere you go, restaurants, service, like everything, like roads, infrastructure. People don't look as nice as they used to.
Right.
It's just overall degradation. And I think your analysis on Ukraine is spot on, because if you look at the gold price breakout in early 2024, that was really the point where it seemed apparent that Russia had this thing in the bag, that Ukraine really had no hope in winning this. And that's really when gold broke out of that $2,000 price level and
never looked back.
Yeah.
Right. And the final point I'll make here is that AI is kind of it's confusing us, because people think that AI is like, it's the next frontier. Like the internet created this 10-year dynamism, even more than that, you could say. but the
Mhm.
internet created this engine for the economy, right? Well, the internet, all the internet did was create jobs, right? It created jobs. Guess what AI is doing? It's reducing jobs. It's doing the exact opposite. People are losing their jobs because of AI, and that's going to pick up speed. So if you're paying attention, you're like, the economy has been degrading, slowly degrading, and here AI is coming along. It's actually going to make it worse. So pay attention. And so 26 and 27 are going to be just absolutely awful years for the economy. It's like we go into recession. It's going to be a lot like 1989 when Japan when they crashed. Their stock market crashed, and then they'd had a Humpty Dumpty crash. They never got back on their feet again. They had like the lost decade. So here comes our lost decade. But it's going to be even worse for us because not only are we going to get that lost decade, but because of America's political fracturing, it's actually going to be much worse because we're not going to come together as a nation because of the political fracturing.
We're too atomized. We're too atomized. Yeah.
There's no way in heck they're going to come together on a solution. As a matter of fact, all they're going to be doing is fighting over what gets cut and what doesn't get cut. That's what they're going to be fighting over. But it's the winner here is gold and silver, and if you're paying attention, you can see that. So today's sell-off is like, from as far as I'm concerned, it's just a hiccup. We're going much higher. But thanks for letting me to explain that.
100%, Don. Anything else you want to talk about in case there's anything left on the table? If not, then we can go ahead and wrap this thing up.
Let's wrap it up. Thanks, Danny.
Yeah, sure thing. Where can people find you if they want to see more of your work?
My website, goldstockdata.com. If you already own mining stocks, it's not really for somebody that doesn't. It's basically a database, helps you to find some new stocks. But if you own any, if you don't own any, then go buy my book. It's on Amazon, How to Invest in Gold and Silver. And that book will show you how to invest in these mining stocks. And if you read the book and you go, this is fascinating, I want to get involved. So I do that. And then follow me on Twitter at Don Durrett. Thanks, Danny.
Awesome. We'll have the links to all that down below. Check them out, guys. And if you got value out of this podcast, drop us a like and comment. Go, Don, go in the comments section. Let me know your thoughts. Do you agree with our analysis, or do you think this is the big one? Are we correcting back down to levels not seen prior to Tuesday of last week? I guess we'll have to wait and find out. But drop me your thoughts. I do, in fact, read all the comments, and subscribe to the channel so you don't miss an episode. And by liking and subscribing and commenting and doing all the YouTube stuff, it helps in boosting this channel and this video in the algorithm. So if you'd like this message to get out to as many people as possible, or if you'd like to support us in a nice and free and easy way, a little bit does go a long way. So may not seem like much, but it certainly isn't. And check us out on Substack at CapitalCosm.com to get access to all of my stuff early and ad-free. And that's all I got for you today, guys. Thanks for watching. I'll catch you later. Bye.